Mosaic Brands Lessons, protecting retailers and suppliers from insolvency risk. Welcome to IO Insolvency Options with Darren Vardy, the Managing Director of Insolvency Options and a registered liquidator with over 30 years of experience helping businesses and individuals navigate financial challenges. In today's episode, Darren continues the Mosaic Brands discussion and draws out the practical lessons for retailers, suppliers, and business owners. He explains why aggressive growth without adequate capital can place suppliers at risk, why household names can still fail, and how payment terms, retention of title clauses, PPSR registrations, realistic forecasting, and break-even monitoring can help reduce exposure. I'm your co-host Anthony Pearl. Let's dive into unlocking more about insolvency options. Darren, I want to continue the story about Mosaic. I think we should talk a little bit as well at the fact that what's interesting about this, and it's not unusual, is that this is a brand that owned multiple very well-known brands we're talking about here. So, and first we probably need to talk about some of those brands, but I want to understand as well that was it one or two of those businesses that caused the issues? Or was this, systemic across the entire brands? Because that's an interesting piece within itself.
I'm not close enough to the detail to be able to comment on whether it was one brand or another which brought about the demise of the group Mosaic Brands. But as I mentioned earlier, and quite often you find is if there is an aggressive acquisition program undertaken and there is no capital funding for that, well then the funds used to acquire these businesses then generally done out of cash flow. And so therefore, unless you have significant positive cash flow available to enable these acquisitions, so it doesn't impact payment to creditors or result in a detriment to creditors, then that's fine. But in this case, as we've seen, as I mentioned earlier, where the company's trade payables are stretched from 120 days to in excess of 200 days, it is clearly evident to me that it was their suppliers' cash flow that were used to go on this aggressive acquisition campaign to acquire all these brands. And I'm unable to comment on the extent of the due diligence done or otherwise to determine whether these brands were in fact profitable brands or not.
I think for people listening in, if you're not familiar with Mosaic as such, we're talking about brands like Rivers, Miller's, Katie's, Rockman's, Noni B. Those are the kinds of brands that are filled shopping centres for many, many years. So they're very familiar to the public and would feel like, these are household names, therefore somehow we feel like they're protected. But, as new shopping centres open up, suddenly the same brands pop up in those ones. So there's always pressure to grow and to acquire more. Is that part of the problem that exists when you have a larger retailing company, particularly one that's owning multiple brands?
I think the issue here is, the real estate it actually occupied. There were a number, there were 1,379 stores at the date of the appointment of the administrators, right? Now, with new centres opening, yes, there is always a carrot to go and enter into these stores and sign up on leases and have a presence in an area, but at what cost? And the cost might not be in the first year or the second year. The cost might be in the tail end of the lease where the fixed percentage increases in the rent, which may or may not be commercial increases, are more than probably CPI. That's when they actually bite into the bottom line. And then you've also got consumer spending habits and ability. And what we're seeing now is we've had the 15 consecutive interest rate hikes. People's discretionary income is getting more difficult and less. So I spoke about the perfect storm when COVID hit, and that hit all retail. And many retailers pivoted. They had the ability to pivot to online, which they did, and a lot have survived off that and managed to scale back their real estate occupancy. But scaling back real estate occupancy comes at a cost as well. And if that cost can't be met, then it has a detrimental impact to the business as a whole.
Retail's a very interesting place, isn't it? Because of the big push to being online. And even your typical stores that have a presence in many of the shopping centres across Australia, very well-known brands, have online specials, so you can't even view them in store anyway. And so there is more and more of a push to that. And yet, is there less foot traffic going through shopping centres? I'm not sure. I suppose it depends on what time of day and when you're travelling and where. But it's a difficult space to be in retail. And I think when you look at those, particularly the larger shopping centres, you don't see many independent small operators sitting in those spaces. It is left to some of these bigger retail chains. And, again, taking back to the Mosaic story, is that kind of a bit of a catch-22?
I do think it is, yes. And this was a business that was built on the traditional retail model. The target market for products was the ladies who are between sort of 40 and 60, the generation that does go into the shopping centre and probably less likely to shop online. And as I said, it's a more traditional customer, hence the more traditional business model with having the store presence.
I guess the cautionary tale then for retailers that are sitting out there and maybe listening into this, what are the things that they've got to do to avoid this, or what are the red flags that they should start be looking for in order to get ahead of the game? Because as you said, when we started discussing this whole retail topic, there's a big bump in the amount of retailers that are going to the wall at the moment.
Yeah. And look, it all comes down to, in my view, again, cash flow management and projecting and forecasting. And I think the forecasts need to be realistic. There's murmurs of recessionary scenarios. We will all know that with the recent interest rate rises, household cash flow becomes tight, discretionary spend is less. And so I think the retailers, depending on the type of retailers, need to look at their business, determine whether they are more of a discretionary spend or not, look at their cash flows to determine what that baseline turnover needs to be to cover the fixed costs of rent, electricity and the like. Work out your break-even income and then be realistic in respect to the forecast to see whether you can achieve the income needed to literally keep the lights on. And if there's doubt or concern that the retailers may not be able to achieve that, that's when they need to seek advice as to what the options are.
And many of the leases that retailers are, let's say, forced to sign, but want to sign because they want to be in a specific space, make it challenging for them, doesn't it?
Absolutely. And, you hear a number of retailers have what they call marquee stores, which are loss leaders, but they just think that they need to be in an area or in a certain shopping centre in a certain location to be seen. And that's fine, so long as there's sufficient income coming in across all stores to cover all costs.
Yeah, I know what you're saying about the marquee stores. It's really interesting, isn't it? Because you walk into some of these and you think, wow, they're amazing. They're kitted out to the hilt. At the same time, they're huge. And then you look around, you see there's quite a lot of staff in there and quite a lot of stock, but not matched by the people. And you start doing the maths going, how much does need to be spent in this store on a day-to-day basis to get them even breaking even?
And that's the key. The key is to be aware of the break-even level and to then monitor the income accordingly.
Well, let's go back to something I know we talked about in a previous episode, but I think we can expand a little bit on it here today, is really about suppliers. What's the advice for them when they're going into dealing with retailers? What are the things that they can look for and what are the triggers they can pull? Because I can imagine that if you're a supplier to what you believe is a significant retailer, you probably feel incumbent to them because you feel this kind of immunity, they're big enough, they're going to pay us.
So I think that the key is always, in my view, to minimise risk. What action needs to be taken to minimise risk? That is, firstly, enter into a supply contract, make sure that you've got security over the goods you supply by way of retention of title clause, as well as a security interest registered on the Personal Property Securities Register to support that. Second thing is, payment terms are payment terms. Make sure that you monitor the payment terms. Now, quite often these large organisations, not dissimilar to government, will request or demand extended payment terms, 45 days, 60 days. You need to make sure that you're on top of whatever the payment terms are, need to make sure that you're on top of getting paid at or within the payment terms. And then if you're not being paid at or within the payment terms, take the necessary action required to remedy that situation. And yes, we've all got to be commercial at the same time. And it's okay to accept 60-day payment terms. But you then need to realise within your business that will come at a cost to you. And you need the sufficient capital and resources and cash flow within your business to ensure that you can accept those payment terms. So it's not just agreeing with them, it's making sure that your business cash flow can sustain that.
And I imagine the lure is the big check, right? You've got a big retailer and you're supplying to them. So relative to the suppliers, it might be a fairly significant check that you're looking at. So there is the lure on one hand. On the other hand, you probably have to be prepared to say no, because if the payment terms start getting out of hand, if the discounts that they're expecting start getting out of hand, then at what point do you walk away and say, this is just not worth it?
Interesting, you made a comment about big check. Big check is not profit. Big check is income. And quite often people mistake income for profit. And my experience is dealing with large retailers and suppliers to large retailers is that whilst there's volume, which gives rise to big check, large payments, what I've often found is that because of the volume, the margins, the profit margin is squeezed. So it'll be high volume, low margin. So then all of a sudden, if you are then delayed in your payment, it has a more significant impact because you need to put more out the door to gain the profit you need to offset the funds being withheld. And that's one thing that, we quite often speak with business owners about is that the income doesn't necessarily mean profit. And business owners really need to be aware of that.
So just to wrap up this whole story of Mosaic, and it's a fascinating story within itself, but also the impact on retailers everywhere. But when we finish this off in terms of the suppliers, how many were affected? How many suppliers themselves ended up in administration as a result, or certainly in bad situations because of this? Did it go far enough to really ruin other businesses?
It certainly did. Absolutely. I don't have the stats on how many suppliers were impacted. I do know that I'm the liquidator of two. There were a number of overseas businesses that I'm told had to shut down from China and Bangladesh, suppliers of garments and the like, and that this has had a significant international impact given the level of debt that's outstanding. And, it's understood that there are some programs on TV which have followed through on that, and that's where that's sort of been derived from, but it has had a significant impact on a broad number of businesses, both locally and internationally.
It really is hard to believe sometimes when you see brands that are such household names and have been such household names for such a long time, to feel like, wow, there was nothing that could save them as well, that those brands have now irreparably damaged, as well as a brand that has left them disappeared for all time. It's an amazing story, and one that there's so much to learn from everyone listening in.
And to an extent, the failure of Mosaic Brands, it can't be denied that the COVID-19 pandemic had a significant impact and contributed to its failure, given the nature of the business. And unfortunately, with all businesses in Australia and throughout the world, we couldn't predict, we didn't know it was coming. It was something that had never occurred historically. I think the closest was probably the Black Plague back in the 1920s, but we don't have, information about how that affected businesses. We were less sophisticated back then. But this is, I think, in my view, just a prime example of how COVID-19 pandemic has adversely impacted a large business.
Well, that's all we have time for in this episode of IO Insolvency Options. We'll continue exploring the practical warning signs and decision points that help business owners, accountants, lawyers, and advisors recognize financial distress earlier and understand the options available before the situation becomes critical. As Darren reminds us through this series, early action creates more choices and better outcomes. We've created a workbook for this episode of the podcast with questions for you to answer, key quotes, and action steps to follow. Check out the show notes for the link to download your copy. For details on how to get in touch with Darren and his team on insolvency challenges, please consult the show notes. This podcast is produced by my team at podcastdoneforyou.com.au, helping professionals share their expertise through powerful podcast content. If you found value in today's episode, wherever you're tuning in, please like, comment, share, and subscribe so you never miss an episode. Until next time, remember, there's always a way forward when you know your options.